Welcome to another edition of Brian's Big Idea. And this week we've got a very special idea. I'm joined by Ed Kovalik of Prairie Operating Company. He's the CEO, and recently I took a trip out to Colorado to see their oil rig and to meet with management and discuss the prospects of this small cap oil stock. So Ed, tell me a little bit more about Prairie Operating Company.
Brian, well, first and foremost, thanks for having me on. It's great to be with you today. Prairie is really a small cap, high growth oriented oil and gas company, really launched by my partners and I about 18 months ago in response to the fact that there are no high growth oil and gas companies left in the United States. And the industry is fairly mature, fairly levered. And so we really wanted to create an investment alternative to the peer group in being fairly underlevered and fairly high growth. So that's what Prairie is focused on. And, we're focused on building our production base in the state of Colorado where we operate.
Right. And a lot of people don't really associate Colorado with oil, but there's a lot of big players in that space. I mean, talk a little bit about the neighbors that you're up against there.
Sure. Well, the DJ Basin in Colorado is unique in that it's one of the largest producing basins in the country, second to the Permian Basin in Texas, which gets all the attention these days. It's highly oily as opposed to gassy, which is one of the reasons we love it. And, it's like every other great shale play. It used to be an old oil field dating back to the beginning of the 20th century. Today, it's been largely consolidated. We're a small player, but we're surrounded by Chevron, Occidental, and Civitas, who have consolidated most of the assets around us. And so we're the beneficiary of all of the work that they've done to date in terms of refining and perfecting drilling techniques, the fracking techniques around us. So, we can basically emulate them by hiring the same vendors, the same consultants that they use for their operations, and drill great wells as a result.
Right. And I think that the point around that is that the major players are basically the neighbors, right adjacent to the land that you guys have. Mm-hmm. And got land leases for over 40,000 acres, right? And then.
Yeah. We have a position it's about 44,000 acres. Just to put that into context, it's about the size of the city of Miami. So it's a lot of land. We have about 500 drillable locations there, and a lot of, proven reserves. And so there's quite a long inventory of development there that we have planned for about the next decade.
Right. And when we talk about the proven reserves and the potential to draw those out, I have seen estimates out there calling for, very large numbers. And, you guys haven't put out any guidance yet, but the expectation is somewhere around $250 to $270 million so far for next year. If we talk about, I don't want to put you on the spot to make you to guide for anything here, but sure. The potential numbers, talk about the idea of barrels per day. And I think we talked a little bit about this when we were out there, of how there's going to be a staggering event where as new wells come on, there's going to be, a spike up and then a tail back down, and talk a little bit about that.
So we have not put out guidance for next year, just to affirm that, because we're really in this high growth, early stage mode of just getting our operations primed. We just completed the acquisition of another asset package offsetting us called Nickel Road as well. And so today we produce about 3,000 barrels of oil per day. We are currently in the process of drilling and completing an 8-well pad, the pad that you visited at Shelduck. That consists of 4 Niobrara B and 4 Niobrara C wells. We're actually just about done drilling that pad. I think when you were there, we were on the 3rd well. I think we're finishing the 7th well this week and the 8th well next week. We're drilling these in 4.5 to 5 days at this point. And so the frac fleet is scheduled to come on location around November 1st, and we'll bring that pad on production in Q1 of next year. And that pad will layer on another, 4,000 or 5,000 barrels of oil per day of production in total. And so to your point, we're stair stepping. Every time we bring on a new pad, we're layering on new production on top of our existing production. And so, part of our strategy is to essentially recycle 100% of our cash flow, less our G&A, back into development. And so we'll pick up momentum next year. Where we exit the year, TBD. I'm not sure exactly when we're going to put out guidance, just because we're in the early stages of this high growth mode we're in. But we'll, drill as many wells as we can get down next year. The other thing we're really focused on, as you know, is M&A. We just completed our first acquisition. It was about $84.5 million in total size. We see a great roll-up opportunity where we are to acquire other things of that nature, some a little smaller, some a little larger. And so I'd be surprised if we got through 2025 without doing some other kind of, transformative transaction. So, there are a lot of ways to grow, and, through the drill bit organically is something we're keenly focused on, but also acquiring as many accretive assets as we can.
Right. And I think one thing that investors in oil companies are all kind of keyed on lately has been the break-even price. So when we think about the break-even, what oil has to be just for you guys, just to break even, we're in that, $45 range, give or take. But with oil as strong as it's been lately, do you guys see that there's going to be extra, is the profit margin strictly derived from that break even and then whatever plus that dollar per barrel is, or is there an opportunity out there for a little higher margin down the road, with higher oil prices?
That's a great question. Our break even and our profit margin is really driven by three things. It's driven obviously by oil price, which we don't control, but even more importantly, it's driven by our cost structure, which we do control. And that's something that we've constantly been trying to refine. Now, that's something that's just going to get better over time because of economies of scale. As you approach 100% utilization of your drilling rig, which is closer to 60 wells per year, and 100% utilization of your frac fleet, which is also completing about 60 wells per year, you're going to see that cost per well decrease over time, which will drive your break evens down over time. And so it's that we're really keenly focused on as a company, is driving those efficiencies and those economies of scale down so that our cost structure is competitive, even in in a lower commodity price environment, and the last piece of that is obviously debt. We're trying to stay as under-levered as possible so that debt service doesn't account for, so much of the cash flow that we can't drill as many wells.
Right. And I think that's the story that really lends well to the retail investor who is looking at this company as opposed to an ExxonMobil or anything else, one of these mega caps. Those guys have huge debt. And, there is the idea that they have had very large debt for a number of years. And in the next couple of years, we're really going to see a lot of that debt come to maturity. And do you think that that's going to be another driver of M&A down the road? Because these big oil companies are going to say, hey, I've got to get rid of some of these assets and pay down some of this debt.
I think for the last couple of years, we've seen a couple big trends in the industry that you've just alluded to. One is a lot of debt maturities have been coming due, and that's going to continue through, I think, about 2027, where we'll see, continuation of debt maturities coming due. Obviously, we're living in a higher interest rate environment than when a lot of this debt was taken on by our peers. And so our peers are, sensitive to hoarding cash more so than spending CapEx so that they can be well positioned to refinance that debt. But the other trend that we've seen is massive consolidation. Today there are 30% fewer companies than there were just 3 years ago. We've seen, the majors, the integrated majors come down market and buy mid caps. We've seen mid caps buy small caps and band with other mid caps. And so the investable universe has shrunk materially, which is also just a reflection of a more mature industry. And where shale is today is that we're not outspending cash flow anymore for CapEx. We're returning cash flow, which is great. And there are a lot of great dividend opportunities out there from, the integrated majors on down through the mid caps, because our industry is so undervalued compared to other industries in the S&P, particularly when you look at our cash flow generation. But Prairie is unique in that, we didn't need to create Prairie to give investors another dividend opportunity. We wanted to create Prairie to give investors a growth opportunity, because frankly, that's what we wanted to invest in as managers. We own a large proportion of this company. We wanted to make multiples of our cash invested, not earn, a dividend. We earn a dividend with our capital invested in other EMPs. And so that's really what makes this company unique and a standout, in that, we're giving investors the opportunity to invest in a stage of value creation that's typically uncommon for investors to see in the public markets. What we're doing today is typically a private equity stage development case where we're compounding growth aggressively. And so, in the face of a fairly mature industry that's really not growing, we think we stand out.
Right. And I think that brings me to my final question here. And this one's the tough one for you, Ed. Are you guys a growth company, or are you guys a value play? Because when we say these things, we see the potential for growth. That's very obvious. There's costs that come along with the growth, and we're going to have an opportunity for higher earnings estimates down the road, the foundation of the Zacks rank. But there's also the idea that you guys are such a value play because there are a lot of assets there, and it's just untapped right now and possibly, as viewed by the public markets. So do you guys consider yourself a value play or a growth play? A little bit of both?
Yeah. I think we're like an Oreo cookie. We're a little bit of both, and they're both great parts. But look, whenever I tell people that we can buy assets for 2 to 3 times free cash flow, they kind of look at me sideways and question whether or not that's true. So I think we are a deep value opportunity because of where we can creatively acquire things that are cash flow producing. But we're also really using the cash flow from those acquisitions to then compound our growth. And so, it's our hope, at least, that the industry trades at better multiples on a go-forward basis and, starts to kind of narrow that valuation gap with other industries on the S&P. And that's why you invest in deep value opportunities, right? Is the hope that you narrow that valuation gap. So I don't think there's any more stark example than looking at us compared to all other industries on the S&P, just because of how cheap we are as an industry.
Absolutely. And I believe that there's an excellent opportunity to see this company grow tremendously. Obviously you've got the assets. One last question, one last commentary thing there.
Mm-hmm.
When we're out there on the PUD and SPUD, you can't spud a PUD. I forget how Brian Freeman told me that one. Where you can spud a PUD. The idea is that the management team and the guys that you have hired alongside as working alongside you guys, top-notch people, just great, extraordinary group of talent here that actually knows what has to happen here. And then when you're all really focused and working on the thing that you guys are focused on here, you really have a huge opportunity in front of you.
Yeah, look, I'm blessed to have a tremendous team around me. Everybody on the team has been doing this for, a long period of time, 20 to 40 year careers on average, coming from all the majors, working for mid-cap companies. And so there's a tremendous wealth of experience on the team. And a lot of people think, what we do in the shale business is kind of dumb, drilling for oil, but you witnessed it. It's pretty high tech. The fact that we can direct a drill bit, 2 miles laterally, horizontally, keep it within a couple inches of variance and target that productive oil interval so precisely is really amazing stuff. And to think that we can kind of turn all that shale into liquid gold is amazing stuff. And so, it's absolutely high tech, and I'd put my team up against anybody else's.
Yeah, I think it's a great team. It's a great product. It's a great idea, and obviously there's going to be excellent growth coming forward. That's why this week's big idea is Prairie Operating Company. PROP is the ticker. Thank you so much, Ed, for coming on and doing this.
Hey, thanks for having me on, Brian. Great to be with you.
Be sure to join us next week for another big idea. But until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.